Good afternoon, everybody. It is Sunday, October 28th, a beautiful sunny day here in North Carolina. And we're going to take a look at the technicals in the market. This past week, we saw quite a bit of technical damage in the market. And I think it has some implications for future trading in the next 2 to 3 months that we need to be careful with. We're going to start our technical analysis by looking at the bullish percent indicator on the New York Stock Exchange. As you can see here, right now we've put in a series of zeros. This started in October, and now we're down to only 34% of the stocks on the New York Stock Exchange on point and figure buy signals. So this put in a sell signal here about a week ago. We've seen considerable sell-off since then. And you'll also notice that this is also in a range where we might see some bottoming action. So I think right now this is a fair amount of technical damage on the market, and the market's going to be looking for some direction in the near future. This chart is the new highs and lows, or high-low percent, for each of the major asset categories. The first one here is the S&P 500. This is the mid caps, the small caps, and the NASDAQ. There are two areas on this chart that we're interested in when they're above +5 or below -5. Typically when you see 2, 3, or maybe in this case all 4 of the asset classes with extremes, this is generally indicative of future market activity. You can see that the S&P has a -15 on the mids, nearly -15 on the smalls, and the NASDAQ is almost 20. So this looks pretty bearish at this point. That also could signify that we're going to see a bottom. This chart is probably my favorite chart for a long-term market indicator. This shows the 20-week and 40-week exponential moving averages. And typically a market's in a bull mode when the 20 is above the 40, which you see right here in this case. You can see that the 20-week is compressing toward the 40-week, and that's interesting. One of the things that I like to watch is this indicator right up here, the RSI. Right now it's at 37.4. Typically when the RSI indicator drops below 50, we see some significant downside. And you can see here in these situations where we did see some rather considerable downside once this broke through. The other area that I mark is I shade the area when the MACD is below the signal line, which indicates that momentum is slowing. So we're looking at a situation here where the RSI is below 50. We're seeing some line compression here. The MACD is below. So this indicates that there may be further weakness. Moving to the New York Stock Exchange advanced decline issues, you can see that this is a zoom, a thumbnail zoom of this last little part here. You'll notice that we have seen a considerable reduction in the cumulative advanced decline. We've put a top in, we've put in a lower high right in this area here. That would suggest that we may be looking for some further downside. You'll also notice that this is very close to going below the trend channel. And as we've noted here in the past, going below the trend channel and putting in a new lower high is oftentimes a marker that something very significant may be happening in the market. This is the SPY rate of change, similar to other charts except for the rate of change pane here at the bottom. You can see that we've had some significant downsides when the rate of change has dropped below 0. This, of course, is the 2000 to 2009 Great Recession area, and you can see that we had a very significant drop below, and that drop happened well before the large drop. So one of the things that I look for is when the rate of change goes below 0. And as you can see right here, we're approaching 0. We're at 2.74%, but we're not there, and we're not below yet. So we had a recent downturn, as you can see here, where the market came down right to the zero line and then bounced off of it. So we'll be watching this very carefully to see if this signifies more potential downside. Here is the put-call ratio on the Cboe options equity only. Two things that we have here. This percentage price oscillator in the middle shows when we are extreme levels of optimism or at pessimism. And very often when we go to an extreme level of pessimism, that's marked a bottom in the market. So we're in that area now. You can also see that there's been a turn up here at the bottom. This is the actual CPCE daily index, and it seems to be beginning to move up. So this would suggest that there are more puts being put in place, more protection added into the system. And again, this could be a signal that we're going to see a bounce from this point. This chart shows the relationship between the Russell 2000 small cap index and the S&P 500 index. As you can see here, for some period of time over the past really 2 to 3 months, the Russell has been well underperforming the S&P. This is we use this as an indication of how much risk is in the market. Typically, when people get nervous, they start to take the small caps out first to reduce their risk exposure to the market. So that suggests that some of this is going on at this point in time. We're not down to the levels where it appears that something more significant may happen, but we've certainly been taking a more defensive posture. This is an important chart to me. This is comparing the S&P 500 equal weighted index to the SPX, which is the cap weighted index. And what this chart signifies is how much of the movement in the stocks is crowded in the top maybe 10 or 15% of stocks in the S&P 500. In this particular case, you see that the equal weight index has come down considerably. This is indicative of the big institutional traders who are taking their positions out below in what I call the second tier, generally the bottom 450 stocks. They'll buy the top weighted stocks and keep the market sort of where they want it while they're going below and taking out all their positions in the underlying or the second tier group. And then when they're ready, they'll take the market down. I think they've already done this, but you can see here that there was some significant activity from July to this point in time where they were reducing their exposure to the smaller stocks in the S&P 500. Here's the chart of the VIX. We have a 2 standard deviation Keltner channel on here. As we've noted in the past, very often when the VIX jumps so fast that it moves more than 2 standard deviations away from its mean, that sometimes or oftentimes signifies a potential bottom in the market. As you can see here in the last few days in this Zoom thumbnail, we popped out and then that was on about the 10th, I believe, and then we're up near it again. So there's a lot of question right now about where the market is going to go. Typically the markets try to see how far they can go down. We're in the middle of earnings seasons, and earnings have been good, but guidance has been a little bit weak, and I think that the institutional traders are taking this opportunity to sort of price the market down to give them a little bit of room to run. This is the chart of the TLT plotted along the SPX. One of the things that you will notice here, I'm particularly interested in the correlation between the TLT and the XPX. Over a long period of time, they're highly correlated. But here you see recently the correlation has been dropping. This sometimes signifies some change in the momentum of the market. Typically, when you see the momentum go negative, that means that they're acting differently, and most of the time that means that people are getting nervous and they're crowding into the TLT. That's not happening right now, but you can see the TLT has popped off of a low, and it could be back up in the 125 area real soon if people get nervous that there's going to be more downside to the market. So keep an eye on TLT as an indicator of I think it's a little bit of an indicator of the fear that's in the market. This chart is the percent of stocks above the 200-day moving average. And as you can see, since really about the 1st of October, we've seen a rather significant drop from the 63 level to right now, less than 25% of stocks are above their 200-day moving average. So again, we're looking at extremes. This is beginning to look a little bit extreme. It may signify that we've sort of flushed out what's going to happen in this market and it's going to stabilize at this point. I don't suggest it's going to turn around and rocket back up. But at this point in time, I think you can see that there's been significant technical damage done to the market to the point that it's going to either bounce and move back up, or it is going to continue down and they're going to see how far they can take it down. We're going to finish up on the Dow theory chart. As you can see, in the beginning of October, the industrials began to move down hard and transportation went with it. They both put in lower lows, confirming a move lower. The industrials have continued to go down. Transportations have gone down a lot faster. This is just indicative of concern about the future. If factories aren't producing things, transportation can't deliver it. So we'll wait to see what's going to happen at this point in the next few days. I think you may see transportation start to move back up and confirm a bounce off of the industrial. But just something to keep an eye on. As you can see, everything sort of points to weakness. So I'd be very careful at this point. If you've got your hedges on, I would keep them there. Look for every opportunity to move them up and just sort of keep an eye on what's going to happen here in the market. I think over the next 2 weeks between now and at least mid-November at the midterm elections, you're probably going to see a lot of volatility. So it's probably a good time to just sort of strap on your seatbelt and stay tight for just 2 or 3 weeks. Okay, so that's it for the technical analysis this week. I'll talk to you guys soon.